Okay, so welcome everybody to today's webinar. Thanks for joining us. Today we have one of our patrons, Kingston Smith, to deliver a webinar on recent tax developments when navigating COVID-19. So just to advise, we are recording this webinar, so obviously turn off your screen if you don't want to be viewed. If you've got any questions, we'd appreciate you either saving them till the end when we'll have a quick Q&A session, or if you think of something during the presentation, you can type it into the chat function, and then Andrew and Silvia will go through those at the end, just in case you think of something and you're worried about forgetting it. So I'm going to hand over now to Silvia, who is a partner at Kingston Smith, and she will introduce the presentation. Thanks, Silvia.
Thank you. Thanks so much. Well, good morning, everybody. So the presentation is a recap and a re-examining of government initiatives around tax for business. And there've been an awful lot of them over the last few months, and probably some more to come out. So as Alison said, my name's Silvia Vitiello. I'm a partner with Kingston Smith, and I'm a general practice partner. But more importantly, Andrew Constable is a specialist tax partner, and he's been dealing with a lot of these things with our clients, both small, big, all sorts of sectors. So he's got a lot of practical insight as to how businesses are looking at the tax changes and the tax initiatives. So I'm not going to take up any more of the time really, other than to say to Andrew, will you talk us through some of the initiatives that have come through from the government, giving us your practical spin on it as well, and also help us to look at how businesses can use those initiatives to plan going forward. As Alison said, happy to take questions. I'm going to be taking notes if anybody wants to pop any questions into the chat function, and we'll come back to those at the end. So Andrew, I'm going to hand over to you.
Right, thank you. Good morning. Good morning, everyone. Yes, so as Silvia said, I've tried to put together some slides on the various tax initiatives that have come up. There's a lot. There have been a lot of developments, so we'll see how we go, and by all means ask questions on things that you don't think I've covered. I wanted to start on the job retention scheme. I think the basic outline of this is now fairly well known, and it's been taken advantage of by a lot of businesses. But I think it's worth looking at, particularly in terms of what's now going to be coming up over the next few months. So, as probably most of you know, the scheme, as it has effectively been since the 1st of March, and as it will be up until the end of this month, allows employers to claim a grant from the government in respect of furloughed employees who they keep on as employees but don't allow or require to work for them. That grant from the government is 80% of the employee's salary, or £2,500 if lower. That amount is then received and paid directly onto the employee whilst he or she is on furlough. The employers also get the associated national insurance contributions and minimum employers' pension contributions on those amounts. And the scheme's been massively popular. 8.7 million employees have had their salary or part of it covered by this scheme. 1.1 million employers. It's cost the Treasury 17.5 billion pounds. So it's been massively popular, massively expensive. It will be changing slightly over the coming months. The changes will start from the 1st of July onwards, although in terms of money and the numbers, they won't actually start changing until August. And the spreadsheet I've put up on the next slide shows how things will gradually change in terms of the numbers from August onwards. So as I say, up until the end of July, there's a grant receivable from the government. The government, HMRC, the taxpayer, call it what you will also cover the national insurance contributions and pension contributions. From August, things start to change, and the first change is that from August onwards, when employees are on furlough, it's the employer that is responsible for the national insurance contributions and the pension contributions on the amounts paid to the employee. From September, the employer's costs start to increase a little more, in that part of the amount that had been covered by the government is now having to be covered by the employer. So the government's grant will only cover 70% of the employee's earnings, or a slightly lower cap. 10% of the employee's earnings, or £312.50, will then need to be paid by the employer. From October, the costs shift a little more to the employer. So the employer is covering 20%, the government only 60%. And then from November, as far as we know at the moment, the scheme will cease. The Chancellor has said that a number of times. I think, as far as we can be sure of anything at the moment, we can be fairly sure the scheme will not be in operation from November onwards. So in terms, just by way of illustration, how those numbers might sort of pan out in terms of a practical example. Up until the end of July, if we've got an employee being paid £2,500 a month, HMRC will be paying a grant of £2,803 to cover the salary and the associated costs. 100% of everything that has to be paid to the employee is covered by the government. From August, as things start to shift, it's effectively the employer paying 10.8% of the total costs. From September, as the employer starts having to pay some of the salary costs, the employer's costs go up to 22%. And then from October, it's about a third. So you can see how things are gradually shifting to the employer. From November, as I say, the scheme will cease, and it will be the employer paying 100% of anything that's paid on to the employee. And that's probably where some tough decisions, I guess, are going to have to be made in terms of whether employees are kept on and employers' costs do start to increase dramatically in respect of furloughed employees, or whether employers are going to start having to make some serious redundancies. I mean, at this stage, it's very hard to know what things are going to look like in November, but at least now we do have a plan as to how costs are starting to shift to employers, and when the big increase in costs is likely to come. So that's how the numbers are going to work. From the 1st of July, a few of the practicalities are going to change as well. So flexible furloughing is going to be possible. It's going to be possible for employees to be furloughed for part of their time, but to work for part of their time. Maybe they might be able to come back and work for 2 days a week, or they might be able to do 3 shifts a week, something like that. That's going to be possible. But no new entrants are going to be able to join the scheme. So employers will only be able to have on furlough employees who have previously been furloughed, employees who have had a full 3-week period at least on furlough before the end of June. And what that might mean for some employers is that if employers, perhaps want to furlough employees who have not previously been furloughed, those employees are going to need to be furloughed by tomorrow at the absolute latest, so that they can get a 3-week furlough period in play before the end of June, such that they can then come back and be furloughed, perhaps part-time, perhaps full-time, from the 1st of July onwards. Also from July, the minimum claim period, the minimum period in which someone has to be furloughed, reduces from 3 weeks to 1 week. So again, there's more flexibility in that regard. And we're expecting a bit more guidance on how exactly this will work out later this week. So so that's the job retention scheme. It's changing in in some good ways, some bad ways, but the implications will depend on the extent to which employers have taken advantage of it and will need to continue doing so over the coming months. We've also got the self-employed income support scheme for self-employed individuals, sole traders, partners in partnerships. There was an initial grant available to those individuals to cover March, April and May. The Chancellor recently announced that there will be a second grant available to cover June, July and August. Those grants are based on average trading profits over previous periods with a cap. And the grant for June, July and August is slightly less than the previous grant to correlate a little bit, I guess, with the reduction in the generosity of the job retention scheme. These grants are available for businesses, individuals, partners who have been adversely affected by coronavirus, who have had trading profits historically of no more than £50,000, and who were trading at least in the 18-19 tax year. These neither of these schemes I've talked about are available for individuals who run their own business through a limited company and take out dividends in order to remunerate themselves. So there are those category of businessmen and women who simply do not get the kind of support that has been available to others. The government knows full well that that's the case, but appears to have made a policy decision that that kind of individual will not be supported at this time. We've had recently draft legislation that will deal with the sort of tax administration of these coronavirus support payments, so the job retention scheme payments and the self-employed income scheme payments. The first point is that those amounts will be taxable. That's, I guess, to be expected because they're either replacing taxable income or covering deductible costs. So those amounts will be taxable. If HMRC discovers that they've paid a grant, but they shouldn't have done, but the grant was not due, they will then raise a tax assessment in order to get that amount back. Businesses have a responsibility to notify HMRC if they have incorrectly claimed one of these payments, or if they have quite validly made a claim, but circumstances claim and change and they have ceased to be entitled to a support payment. So the responsibility is on businesses to notify HMRC if they have received something they shouldn't, and that will then enable HMRC to raise an assessment to get the money back. Failure to notify HMRC that something is due back to them will result in quite severe penalties, penalties of between 50 and 100% of the amount of the grant. And perhaps in the case of a business that has put quite a number of employees on furlough, you can see that the amount at stake there could well be quite high. So as well as having to repay the grant, there will be these quite high penalties for businesses that do not notify HMRC, do not act in accordance with the rules and the spirit of this very helpful support. Members of partnerships and LLPs will be jointly and severally liable for the repayments of any grants or any penalties. Directors of companies could even become jointly and severally liable with the companies for the repayments of any grants. So I think this legislation indicates that HMRC are really going to police this issue quite harshly. As I showed earlier, it's cost the government a massive amount of money, and I think perhaps quite rightly, the government is going to take quite a strong line in making sure that compliance with the legislation here is as high as it possibly can be. So that's probably enough on those coronavirus support payments. The next issue I wanted to just talk about was working from home, and the fact that working from home has obviously increased massively over the past few months, and a few of the tax issues that affect employees that have had to work from home, where previously they haven't been doing so. Employees are able to reimburse incremental costs incurred by those employees as a result of working from home. So extra heating costs, lighting costs, and so on. Employers can reimburse those costs to employees, or they can pay £6 per week without any tax implications. If employers don't reimburse costs or pay those amounts, employees can claim their own tax deductions. Strictly, those tax deductions can only be claimed where they're required to work from home. But I think the coronavirus situation will definitely tick that box. What about office equipment? It's long been the case that employers have been able to make office equipment available to their employees where they're working from home without tax implications. So they can, send a desk, a chair, a computer to their employees, and that's fine. There's been a relaxation on the existing rules whereby employees have now been able to go out and buy their own equipment that they need for working from home. And if employers reimburse them for that, if employers reimburse the costs they've incurred, that reimbursement will not have any tax implications at the moment and up until April of next year. So employers can support their employees going out and buying desks, chairs, printers, whatever it is they need in order to work at this time. Okay, next few slides might not be relevant for everyone joining the webinar, but I thought it might be useful for some, and it might also be useful to everyone, just to demonstrate some of the flexibility that there is in the legislation already, and some of the flexibility that we expect HMRC to allow and to use in the right circumstances. So firstly, I wanted to talk a little about companies and their tax residency. So UK incorporated companies are UK tax resident, and they're subject to UK tax on their worldwide income. Non-UK companies can become tax resident if they are centrally controlled and managed in the UK. And that really relates to where directors are holding their board meetings and exercising the top level control over the company. Now, very helpfully, I think HMRC have said that they do not consider that a company will become resident in the UK just because a few board meetings are held here, or presumably joined by video call from here over a short period of time. So it might be that there are UK resident directors who are trapped here. They can't go abroad in order to join board meetings of non-resident companies, but that won't necessarily bring those companies within the UK tax net. And we can expect similar sensible, pragmatic approaches from other jurisdictions in that regard as well. Similarly, we wouldn't expect a non-UK company to come to have a UK taxable branch or taxable office just because it has some employees sort of trapped here, or having to spend some time working here over the current months. From a personal point of view, it might well be that individuals are in the UK and having to spend a lot more time in the UK than they had planned. The UK personal tax residency it often comes down to the number of days an individual has spent in the UK in a particular tax year. Now, the legislation allows for up to 60 days spent in the UK to be ignored, where those days are are spent in the UK as a result of exceptional circumstances. And again, HMRC have allowed a number of circumstances that might arise as a result of COVID-19 to fall within those exceptional circumstances. So there's a list on the screen now of circumstances where HMRC will accept that individuals might be kept in the UK for longer than they had planned and longer than they want to be. And again, this may well keep individuals out of the UK tax net, whereas otherwise they might have come into the tax net. So I think so far, I think my message is that there is some flexibility. There are circumstances where HMRC are adopting sensible and a pragmatic approach. I expect that HMRC will continue to do that in the right circumstances, but where there are perhaps individuals trying to take advantage of some of the support that's available, they will probably take a very harsh and severe approach. So just in what's left, I wanted to run through a few things a bit more quickly. Firstly, I've identified a couple of tax changes that have been delayed as a result of the disruption caused by coronavirus. So firstly, off-payroll working rules for the private sector. Now, this is a set of rules many of you will have heard of. They were due to come in with effect from the 6th of April 2020, but that was delayed to 6th of April 2021 to give businesses more time to get their head around what these rules mean and what they have to do in light of them. In very brief terms, these rules apply where a medium or large business takes on workers, and those workers are providing their personal service, but doing so through intermediaries. So normally they would be doing so through their own personal service companies. Now, when these rules come into place, the end client, so the medium or large business, is responsible for looking at that worker, looking at how that worker is working, and deciding whether that worker is working as if he or she were an employee. If so, that worker or an agent in the chain is then responsible for deducting PAYE and NICs from payments made to the personal service company as if they were employment payments. So there's a lot to do in light of these rules, but fortunately businesses have a bit more time to get their heads around it if they hadn't already done so. Making tax digital. So this is the requirement that came in last year for businesses to maintain their VAT records electronically and to submit those records directly, or to submit the VAT returns directly from those records to HMRC electronically. There was a soft landing period whereby if a business needed to sort of copy and paste data from one bit of software to another bit of software as part of the process, they could do so. That soft landing period was due to end this year, but businesses will now have until next year in order to make sure that there are those digital links throughout the software where it's required. So again, a helpful relaxation for some businesses. Some things that have come in or are coming in or are required at the moment which haven't changed, which perhaps might be a bit frustrating for some taxpayers. Firstly, there's been no general relaxation or extension to tax filing and reporting deadlines. So perhaps most pressingly and most generally, forms P11D, reporting benefits, employment-related securities returns, reporting employee shares, employee share options. Those are still due as normal at the beginning of next month. There was a change to the principal private residence relief rules from the start of this tax year, essentially reducing the way the exemption from capital gains tax can be available at the end of a period of ownership of a property. This exemption really allows individuals to move and to still claim a capital gains tax exemption, even if they can't sell their old house immediately. The period that exemption can cover was reduced from 18 months to 9 months from the start of this tax year, and the timing there just might be a little bit unfortunate, because we might now be in a period where people are struggling more than they had previously to sell their previous houses. Next, HMRC are getting a more preferential status in liquidations for certain tax debts with effect from December this year. So whereas previously they would have been unsecured creditors along with all the other unsecured creditors, they are getting a much more preferential entitlement to PAYE, unpaid PAYE and unpaid VAT within businesses that have gone into liquidation. And again, I think the timing of this might be a little bit unfortunate. December 2020 might well be when some businesses are that have been struggling are going under, and the fact that HMRC are now going to be getting this preferential entitlement to what may well be a lot of money might well cause other creditors to perhaps try and recover their money, push businesses into liquidation sooner than they otherwise would, to stand a better chance of getting some of the money back from those businesses. Okay, and also loss carryback rules. There haven't been any changes to the ability for businesses to carry back losses and use them against taxable profits from earlier periods. In 2008-9, at the time of the last financial crash, there was an enhanced ability for businesses to do that. We haven't had anything like that yet, but maybe over the coming months we will get some kind of relaxation or extension there. If so, I think that will be welcome for a number of businesses. So finally, just a couple of quick points on what businesses might want to do. Things that I haven't covered already, but things businesses might want to do. Some employees might want to waive some of their remuneration. They might want to take slightly less of their salary in order to help the business, or maybe to enable a business to make charitable donations. The point there, I think, is that the employee and the employer should agree to a reduction in remuneration before the remuneration is paid, because that will make sure that then the amount that the employee isn't receiving is not subject to tax and NICs. Businesses might well be looking to incentivize and to remunerate key employees, those employees that are really valuable at the moment or might really be valuable over the coming months as things really start to get going again, hopefully. They might want to do that, but they might be they might be under restrictions as to the amount of cash they've got available to do that. They might want to think a bit more creatively about remunerating and incentivizing key employees, perhaps by taking advantage of tax-free benefits, perhaps by looking at share schemes, maybe looking to grant share options, award shares. That kind of approach can help incentivize, lock in employees, perhaps without the same amount of cash outlay as a salary increase or bonus might do. And it might be particularly useful to think about those kind of things at the moment, where perhaps valuations of the company shares are lower, and therefore any tax implications of share options or share awards would be lower than they otherwise would. And finally, to draw things to a close, businesses should continue to remember the fact that they don't need to make VAT payments up to the end of June until March of next year. Income tax payments on account that would otherwise be due at the end of July, again, they don't need to be paid until next year. Time to pay arrangements can still be available for businesses with cash flow difficulties. VAT bad debt relief for businesses whose customers are having difficulties in paying them. R&D tax relief, all those other reliefs that might help businesses out and potentially give a measure of repayable tax credit. Those things should all be considered, and perhaps might be more important now than ever. We at More Kingston Smith, we've got a coronavirus hub on our website, which we're regularly adding information to, not just tax information, lots and lots of other information as well. So, I would say businesses might well want to keep abreast of what's on there. And finally, I think everything the government's doing is costing a massive amount, and tax rates may well increase in the future. Businesses might well be tempted to push things back, but ultimately that might well not be the best thing to do. So the temptation is to push things back into the future, but tax rates may well be higher in the future, and ultimately that might well not have been the best decision. Okay, and that's all I've got. So there's a lot there. I could have said even more, but hopefully that's given everyone a flavour of what's been going on in the tax world.
Thank you. Thanks, Andrew. I've got a few questions actually,
Great.
just from some of the people. I've been writing those down as they've come in. So that was great, and I know it was a whistle-stop tour through, because I know there's so much that you could say. There's been a lot happening. One of the questions was, if an employee comes back to work under flexible furloughing, how will the government grant be calculated on that?
Well, it will be proportionate to the amount of time the employee is coming back. So
Right.
yeah, so let's say the employee is coming back for 2 days a week. It will simply be 2/5 of the grant that would otherwise be available. So let's say the grant would have been £2,500. It will be £1,000 in that case. Or sorry, I've done that the wrong way around. If the employee's on furlough for 2 days a week,
yeah,
it will be 2/5. Yeah.
So it's just a pro rata on it.
Yeah, exactly.
I'm getting some questions coming in around which order should I do. How sympathetic will HMRC be to missed deadlines at this time? Do you have a feeling for that, an insight on that one?
Well, I think and hope they will be fairly sympathetic. They have specifically said that that coronavirus can potentially give rise to extenuating circumstances, reasonable excuses. So businesses that have missed deadlines because of the way they've been affected, HMRC have specifically said they will take all of that into account. And yes, I think businesses that are genuinely working hard and trying to do the right thing, I'm fairly hopeful and slightly confident that HMRC are going to be sympathetic. Yeah.
They are talking a bit more, aren't they? I think we've all seen that. I had a question. Yeah. The July HMRC obligations can be delayed until when? They were asking, when can those be held over till?
So the income tax payments on account.
Those payments on account, yeah.
Yeah, the payments on account that would be due on the 31st of July do not need to be paid until the 31st of January next year.
Right, so they all become that balancing payment at the end.
Yes.
There's no payments on account. And
right.
I've got a question on SEISS. grant. I find that very hard to say. What
Yes.
circumstances would need to change for those of us on SEISS grants, so that self-employed grant, to need to inform HMRC? So what would be the sorts of things that would change, which would require information to be passed to revenue?
Oh, okay. So yes. So this is, I think this relates to where a grant has been validly changed, but validly claimed, but it turns out that later that it, that it shouldn't have been, and that that's a good question. So what could change? Well, the grant is only available for businesses that have been adversely affected.
Yeah.
So I guess it might well be that that business really really
I think
comes
you need
back
to
and
be able to
starts booming.
demonstrate.
Yeah.
Yeah. I think if your profits were probably higher than they would have otherwise been, which we have seen
Yes.
with some businesses have been able to take initiatives, or maybe if the start date, it actually hadn't started at that date. So we've seen some clients, unfortunately, have missed out on being able to claim the SEISS grant because their businesses are reasonably new. They had to be in place by April 29. Getting it wrong. The date they had to be
on or before that. April 18. April 19. So they needed
19,
to have done.
Yeah.
They needed to have done something in the 18-19 tax year.
Yeah. So it's things like that. I think if you have made a sensible claim for it, if you've actually really looked and made your claim, you've got to have some special circumstances for you to fall out. But if you do fall out of it, it is incumbent upon the individual to go back and disclose that to the revenue. I've got some questions around, I'm going to group those questions. So around how would a business be valued right now and what discount would be applied? And I think something, I know that's a very big question. There isn't a magic number, by the way. I know I can say that, I'm absolutely sure. But also around incentivizing employees when you haven't got much cash, but you really want to keep the real talent in your business. And so we all know share option schemes are really important around those areas. And you mentioned, I think on one of your slides, it's a good time to maybe look at some of those options because of the valuations being lower. So something around business valuations and tax.
Yes. Okay. I think it would be very hard for me now to say how business valuations might be affected. Some businesses some business values may well not have fallen because the business is just as strong as it had been. Others may really have been affected, and it may well be that the balance sheet is so much weaker, the prospects of profits over the next few years are so much lower that that really the value of a company is just a lot less than it might have been if we had looked at it at the end of last year.
And I think it's around confidence as well, isn't it? I think if you're looking at setting a value and you're looking to maybe take it a lower value because you're looking at something like share options, now is a good time to look at it. You can demonstrate that there's more hope value perhaps, but less certainty in it. And so the argument for depressing the price, if that's what you're looking to do, obviously there's different reasons why people want to push prices in all sorts of ways. So I think the question on what discount would be applied, it is whatever. It's an art, not a science, I think, the valuation of businesses. But I think the particular situation that we find ourselves in now does lend itself to a lack of certainty, and that always depresses valuations on businesses, I think is fair to say.
Yeah.
It's not a finite answer, and I do apologise to the person who raised that one, but it is a very difficult one to answer.
Yeah.
I had something around creditor status, because we talked about that, the HMRC creditor status changes from the 1st of December. And just to clarify, because I think it was a really big point, I know it's more to do probably around insolvency practitioners would be interested in it, but just generally from a tax point of view, the revenue are changing their status in terms of their ability to claim funds back in a liquidation or something from the 1st of December. Is that for debts that occur after that date, or is it for debts that have accumulated up to that date? And of course, the important point on that is, of course, some businesses are rolling up quite a lot of revenue debt at this moment in time.
Yeah, so my I don't know if there are any insolvency practitioners on the webinar. If so,
I'm looking to see if they come.
Perhaps they can comment. My understanding is that relates to insolvency proceedings beginning on or after the 1st of December.
Yeah.
Okay. So it may well be that if businesses delay paying their VAT, as they're perfectly entitled to do so,
Yeah.
if they make time to pay arrangements in respect of further VAT and PAYE, it may well be that VAT and PAYE debts are very large. If they then go into liquidation on or after the 1st of December, all those VAT and PAYE debts, HMRC will have the priority.
They stand in priority.
Yeah.
And that's your point
too.
about other creditors maybe pushing for an action in advance of December.
Yeah, maybe, yeah, or it may be after December. I guess other creditors might want to push businesses into administration, or liquidation sooner, so that so that they get some of the money before
they're protecting.
So they get some money. Whereas if they held on for longer, HMRC may get all of the money available. Yeah.
And then there was one last question around interest on these deferred payments. So where they're being deferred, just to confirm, is interest going to be charged on deferred payments that are being put through with revenue?
Yeah, so with the VAT, the VAT that HMRC have specifically said does not need to be paid up until the end of June, and the income tax payments on account that do not need to be paid until January, interest will not arise on those. So delaying those payments will not give rise to any interest or penalties. Where other time to pay arrangements are made, interest will arise. Interest will be charged from the normal due date.
Yeah, thank you. And the one thing I think I would just highlight was about the waiving of remuneration, which you made, and that the timing of that is really critical, isn't it? Otherwise you can get unintended consequences, in that somebody may waive their remuneration but still fall to be taxed on remuneration which they didn't actually receive, which would be the worst of all worlds in any time. But just to be aware of that it's crucial, I think, to get your paperwork right.
Yeah, exactly.
Sorry, I put that very bluntly, didn't I? Get the paperwork right, get your decisions in the right order.
Yeah, absolutely.
I'm just looking, I haven't got any more questions that have come through at the moment. Is that right? No one else? I'm just looking to Alison. She's not got any.
Yeah, no, I haven't seen any others. So no, I think that's it. Thank you so much, both of you.
Thank you.
Yeah, that was very detailed. The slides, I know we've had permission to share those afterwards.
Yes.
Thank you very much. So we'll get those out to everybody, and also we'll send your contact details, Sylvia and Andrew. So if anyone's got any, does think of any questions, they can contact you about that afterwards.
Absolutely. What I would say is, Andrew mentioned, but the coronavirus hub that we have on our website is being updated on a daily basis. So it has not just the technical announcements that are coming out and the analysis of that from tax or whatever that is, but it also has some insights. So we're gathering a lot of things, that we're talking to lots of different clients and our own experiences, because we're running our own business too. So we're putting lots of things on that website, and they're changing as the government make announcements or as we learn new stuff. So if you come one day, come back the next day and have a look, because we've got a lot on there. There's all sorts of webinars and podcasts and initiatives that we're working with. So it's very hard to say what's on there, because it will change from time to time.
Absolutely, yeah, thank you. That's great. Thanks so much, both. And have a good day, everyone. Thanks for joining us.
Thank you.